Hello, this is Derek Iswell, Chief Investment Officer for Shelton Capital Management with the Shelton CIO Minute. Instead of engaging in the relentless talk about the Fed, jobs data, today I'd actually like to look over to the other side of the Atlantic to view some of the activity and investment opportunities in Europe, particularly given the fact that in the first couple of days of this year, the European market's been extremely strong. The Stoxx 50 index of European companies as of last night was up nearly 4.5%, while the S&P 500 over the same 3 and 4 day period is actually down 75 basis points. Now, today's market activity has closed some of that gap, but the question remains, what is going on in Europe to trigger this degree of outperformance? So stepping back and reflecting back to last year, Europe is basically about 6 months behind the US within this whole inflation and interest rate cycle. And that's understandable. First of all, they did not engage into the same degree, the same amount or pace of fiscal stimulus that we did in the US. And second of all, a war broke out right there on their doorstep, which has distracted them to some extent. Now, Europe still hasn't experienced the same levels of inflation that we have here in the US, but more of that inflation is coming from energy and commodities, particularly food, instead of the core sources of inflation that tend to be more persistent and a better predictor of inflation going forward. Having said that, near the end of last year, the European Central Bank took a very hawkish stance, prioritizing inflation in their notes and within the forecasts of their activity for the next year. Now, they may not have to fight very hard. Subsequent and after those announcements, recent CPI numbers in Europe surprised everyone to the downside, with the expected levels of inflation being almost 0.5% higher than the actual levels of inflation that came in their recent CPI data. And as a result, German Bunds, the benchmark bond of Europe, rates on those bonds fell about 30 basis points. Leading indicators in Europe are also weak like they are in the US, but latest purchasing manager indications were around 49. Now 50 means that we're getting into an area of future growth, but 49 is still a bit better than what we're seeing here over in the US, where our PMI levels have been closer to 46 and 47. So not time to get excited or to expect huge amounts of growth going forward, but on the margin, somewhat better than what we're seeing here in the US. And on top of that, Europe is still cheap. This chart here shows the 10-year average PE, the so-called Shiller PE, of Europe and the UK versus the US, going back some 25 years. And see, for many years, the valuation levels of the two regions were basically in lockstep. But since the euro currency crisis of the early aughts, the US has outperformed. And despite the reversal, the outperformance of Europe in 2022 last year, US markets are still about 6 or 7 points more expensive than Europe. A lot of that being due to the larger portion of big growth and technology stocks we have in the US. So there's still room for further reversal. And if you mix in the record levels or record valuations of the dollar versus the euro, well, there's plenty of reasons then to think about allocating or taking a look at putting some investments in this part of the world. Thanks for your time. If you have any further questions, please don't hesitate to contact your Shelton Capital representative. This has been a Shelton Capital CIO Minute.